Hi guys, this is your favourite YouTuber again, Dami Solari, and you're watching DS Planet Finance. Well, today's episode is about the 9 different varieties of stock companies that you can invest in. Can you believe there's actually 9? But yeah, if you guys want to find out what they are, and maybe you find out if it tailors to you, then stay tuned, keep watching, you know it's coming, Okay, so company number 1, well, type of company number 1 is the blue chip companies. These are your creme de la cremes. These are your go-to companies. These are your reliable companies. These are the companies, for example, Google, Apple, the companies that you can see 10 years, 20 years down the line still lasting. Those are blue chip companies. Also, you'll find that blue chip companies, they have sort of steady growth rather than sort of drastic, highly risky other companies which tend to be smaller because of their riskiness. So with the blue chip companies, the key is the steady growth and the fact that obviously it's growing. Your second company is the recovery stock type of company. These are the companies which have taken a battering in the past, but it seems like they can actually do a complete 180-degree turn and actually make some decent money from. So these are sort of companies which have drastically lost market share in terms of obviously shareholders investing in them. The reason why they could be on a recovery is the fact that maybe they might have some new management, some management that maybe investors believe in, some maybe particular people are looking to be execs on that board of the company. Investors will have a sort of reliance on that new management coming into play and the fact that they can actually turn the company around. That's a good example of a sort of recovery stock. Also, it could be the fact that the market is seeming to have completely flipped over. So in the sense of people have lost interest in the past, yes, but now people are really back interested into it. Number 3 is your cyclical stocks. So these are the stocks that go in the same direction as the economy. So if the economy is doing well, they go up too. If the economy is doing bad, they go down too. So you'll find that these sort of companies are the companies which aren't a necessity, it's more so a luxury. So a good example is a sort of leisure company. When the economy is doing well, people will be more than happy to pay for sort of transport, will be able to pay for a sort of travel, book more flights, stuff like that. Those are sort of cyclical stocks. Whereas if you flipped it the other way, in a recession, you wouldn't really want to be going on a holiday. You wouldn't really have money or the time to go on a holiday because you'd be more concerned with trying to turn over again and make sure that the company's prevailing. So that's why they're called cyclical companies, because they come in cycles. My 4th type of company to invest in is your counter-cyclical companies. Now, as you can probably guess, it's the opposite of your cyclical companies. It's the opposite in the sense that when the economy is doing well, they do inversely as well. So if the economy or the market is booming, they wouldn't really do as good as you would think they would. So whereas if you were to flip it the other way around and it was in a recession, that would be their time to shine. So a really good example is in your sort of bare basic clothing companies. So in the sort of recession period, people will be buying those sort of clothes more just because they're cheaper. They're bare basic, they're enough to basically get by on. But if you were to flip it the other way around, where the market's going up and the economy's going up, people have the money. They're less likely to spend on cheaper things and more likely to spend on luxurious things. Point number 5, you have the defensive companies. Now, this one really sort of caught my eye because I never really thought about it. So But it's weird how simple it is, but it's really actually quite clever. So defensive companies are companies that withstand the test of time. They're companies that whether the economy is booming, whether the economy is in a recession, these are the companies that will prevail regardless. These are the companies that people will still rely on. One of the examples would be your sort of supermarket companies. The reason being is whether in recession or we're in a great sort of booming economical time, everyone still needs to eat regardless. So even if you're down to your last penny, at the end of the day, when your stomach's rumbling, and you have to eat. So supermarkets are seen as sort of defensive companies. Your Morrisons, for example. Another good sort of type of defensive stock company would be your bin company, so your Biffa. That's a good example because you just imagine, when the bin men go on strike, it's like all hell breaks loose. Everyone's seen looking on the roads, and you see all the bin bags everywhere, and it just looks messy. So those sort of defensive companies are the companies that withstand the test of time. So whether the economy is doing successfully, whether the economy is doing poorly, we can't live without those. And so people like those sort of companies because it means that they're more steady, they're more dependable. You wouldn't expect to sort of drop massive, huge amount of drop in like share price, for example. You wouldn't expect that from a defensive type of. Your sixth company is your growth stock company. These are companies which you can see down the line in the future, maybe the near future, maybe a long future. You can see that company growing massively. You can see that company potentially being at the forefront, being the big dogs in the future. A good example is GoPro, because the fact that they do these wonderful cameras that re-envision your everyday life as it goes by. Also, big sort of pushing point that labels them as or grow companies is their drones. Drones is a big growth industry because of the fact that you have people saying that you have companies like Amazon, the mailing systems where they're actually pushing for drone delivering mails to your door. Imagine if everyone had drones delivering their mails to their doors. Imagine if GoPro was at the front of the ship steering that. You can tell that GoPro's share prices would have increased by then because they're just so pivotal in the mailing system. From that you can see that it's the sort of company where it's not just about the now, it's more so about where they're going to be in the future, and you can see the integral importance of them now, and you can see where they are looking to get to in the future. Seventh type of company to invest in are your value stock companies. These are the companies which have wonderful prospects in terms of financially. They have good statements, good cash flow, good income statements, and so on, good balance sheets. You have wonderful prospects in terms of their market share. They're completely bossing it in the market. Wonderful prospects in terms of actually their 10Ks and their 10Qs. Their business plans are on point. Those are your sort of value stock companies, but at the key point, they are undervalued. So what you're looking to do as a value stock investor is catch those sort of companies that you know are integral, that you know are really important, but everyone's completely overlooked them. You want to catch them at those points because of the fact that they will be undervalued. And then from obviously investing in them, you're hoping to make a profit later on down the line. When people actually go, you know what, this company is actually really important, then the share prices will skyrocket. So that's what a value stock company is. It's the company which you catch at an early time because you realise that this company is actually really important, but a lot of people have overlooked it, and then you're looking to make a profit from in the future. Company number 8 is your penny stock companies. These companies are notorious for being risky. These companies are notorious for being worth 10p or less. That's the sort of criteria that describes a penny stock company, when it's worth 10p or less for one share. And you'll notice that with these companies, they're worth that price because of the fact that they're just so risky. one second they could be worth 10p, and another second they can be worth 1p, another second they could be worth £1. So obviously with risk comes benefits, but also with risk comes losses as well. So I only recommend going for penny stock companies when you know what you are doing and you're a good analyst. And your ninth company is your shell companies. This one was very interesting because I never actually realized how these companies actually operate. So it's a shell company is like what it sounds like. It's a company that has a sort of, from the outlook, it looks like it's a proper company, but actually inside it's just empty. So it's a shell company. It's when you have companies run by accountants and lawyers, but don't actually have any operating company within them. So they're run by cash, and there's no sort of operating company inside it. So if, I don't know, the government was to do any sort of analytics into what that shell company is actually doing, they would be able to only find that it's filled with accountants and lawyers, and they would only be able to ask those people that are actually working for the company. So a shell company is quite hollow in the sense of it's from first appearance it seems like it is a well-established company, but really and truly it's not actually a company. It's more so a vessel from which people invest in. Also, shell companies are really good for owning assets or opening a bank account where you don't want money trailing back to yourself. So think about it, guys. That sounds so sketchy, doesn't it? Because of the fact that companies that are shell companies tend to be they tend to have a bad agenda. They tend to be fraudulent. There's not a good stigma around shell companies. I will, to be honest, steer clear of them in general, to be honest, because even though it may actually be a good company, maybe actually doing what it needs to be doing, what it should be doing, just the general stigma associated with them, majority of them tend to be fraudulent. So yeah, be wary of shell companies. But to sum it all up, guys, my perspective of it is you shouldn't just invest in just one type of company. You should have your hand dipping and dabbing in multiple pots. So like the way I see it is, why not have majority of money in blue chip companies or defensive companies? That way, you know, majority of money is stable. You're likely to have a sort of steady growth. You're not going to expect any sort of drastic drop in your money that you've invested. So why not have majority of your money there, and then have maybe a bit of your money in your sort of growth companies for a long term. Maybe 10 years down the line you want to be making a good amount of flip on that investment. So why not have a bit of it there? And then if you're really experienced, you could have maybe like a tiny portion, maybe like 1% of your money in your penny stocks, because they're quite riskier and you can benefit from the profit. So my point is, just because obviously there are different types of stocks doesn't mean that you just have to assign yourself just to one. You could dip and dab in multiple ones. And with that said, guys, that's the end of my video for this week. You know it, you know it's coming. But yeah, before you can continue, before you can go doing what you want to do for the rest of the day, you know what to do. LSS, like, subscribe and share. DS Learning Finance. Well, bye.